okay, this is the last rebound in a bear market, which is what we saw in July, August, September of last year, and that gold should now have one more decline, spike to new lows, and then it gives you a very clear target for what the first impulse wave of that new bull market should be.
Insider buying is surging, and legendary investors are piling into one specific gold deal, where the founders have already earned investors 500 and 900% gains on their two previous companies in the past 11 years. Insiders own 40% of the company. This is the gold play you don't want to miss out on. Learn more at crushthestreet.com/insider.
Hello, everyone, and welcome into CrushTheStreet.com. I'm joined today with a new guest. His name's Eric Hadik, and he's of Inside Track Trading. And for the last 2 years, Eric has been writing about his expectation regarding gold that 2016 would be the golden year, and that any meaningful advance in gold and silver would wait until January 2016 to kind of take off, and we actually have seen that. So I'm really interested in talking with him today about precious metals and his cycle analysis. So Eric, thanks so much for taking the time to come on the show with me today.
Thanks very much for having me, Kenneth. I appreciate it and look forward to our interview.
Eric, first of all, since you're a new guest, could you just give us a little bit of information on who you are and why it is that you do what you do?
Well, I have been involved with the first and foremost with the futures markets since the early 1980s, and soon after getting involved, primarily from a technical analysis perspective, discovered the works of W.D. Gann and also Elliott, and it was really kind of the underlying thread through both of them of cycles that really began to intrigue me and take the majority of my focus in the 30-plus years since then. And studying cycles has really been my focus, as I said. But the thing that I learned very early on and have applied ever since is that any of those type of analyses can be very general, very ambiguous when it comes to actually applying them to the markets and getting down to the practical. And so right from the start, I had studied a lot of different technical works and different indicators and formulated really a toolbox of indicators that I use to take that cycle analysis down to very specific and pragmatic approach to the markets, with also being able to identify risk points and proper money management when utilizing those cycles in the market.
So Eric, I should have mentioned that in your introduction, and that is that you do cycle work. And so tell us a little bit about that. I know there are some different guys out there who do cycle analysis. Tell us about what type of cycle analysis that you do, and is it different than the different cycle work that's out there?
I would say in that there's some overlap and also quite a bit of distinction. I approach cycles and cycle analysis from a few different standpoints. One, first and foremost, are the cycles that are pretty constant in our world, in nature, and in the markets, and I see all three of them as being very closely interrelated. And applying those cycles and studying what they have, how they've impacted each of those entities, and what expectations can be derived from them. Excuse me. Secondarily, I look at time frames or cycles occurring between specific highs and lows in different markets. and recognizing that that type of cycle will impact a market for a certain period of time until a larger or smaller overriding cycle kind of takes precedence and kind of shifts gears. And that's where the technical analysis and the price indicators and other corroborating signals are vitally important. So I'll look at these spans between highs and lows, projecting them out as well. And then there's some other time price indicators I use that are a combination of cycles and some specific indicators that I've built to work with cycles. So it's varied in the different cycles that I will discuss and approach, but again, it's all brought down to a very specific application so the traders can actually use it.
Eric, I'm reading the Zero Hedge headline right at the moment. It says 2016, the year wishful thinking fails. And I had to chuckle because it's just these headlines are so creative sometimes, and it's just it's almost comical. But obviously they're talking about very serious things. But I want to ask you about gold. A lot of gold bugs out there have had a lot of wishful thinking that precious metals are going to go up, and we've seen that happen to a large extent from December into January, and we are seeing precious metals rise pretty substantially. And you've talked about that, being that January is the time that we would see it. So talk to us about gold, and then we'll move over to silver.
Well, gold, the important thing is to recognize what has gone on since 2011 and the decline in gold and silver. And, as you mentioned, all the gold bugs, in late 2011, throughout 2012, 2013, 2014, you could just keep reading the headlines that, the next 6 months are going to be astronomical. Gold's just going to the moon. And, after a certain period of time, it's kind of the broken clock syndrome. Well, sooner or later, those projections will be right, but how can you use it if you don't know when to time it? And there were some real key things going on with gold. One of them was two primary price targets that I had since the top in August, September of 2011. And the first one was down around 1130 in gold, and that was another case of price and time coming together that leading into 2013 and 2014, I identified that if that target was hit before a certain time frame, it would trigger the second target, which was 1033 to 1045 in gold on the downside, and that would be the ultimate downside target. So for the last year and a half, that's what I've been focused on, gold getting down to that range, 1033 to 1045. And along with that was a combination of a lot of cycles that pinpointed 2015 as being the low when I thought, the year when I thought a low was most likely. There was a lot of corroborating cycles in various commodities and also in oil, which was projecting a drop into the first quarter of 2016. So all of those things kind of worked together in formulating my approach, and that's why for the last couple of years I had been publishing these reports called 2016 the Golden Year, and kind of warning readers that not to put too much credence in any bounces that we saw in between then and now throughout 2015, that they would be reactive bounces, but they also would provide some guidance and some clues as to what to expect once January 2016 rolled around. And that's one of the key things that I've talked about recently, the last few months, and that was just fulfilled on February 11th. And that was an indicator I call a foreshadow, and without going into it very extensively, it's got to do with, in a bear market like gold was in, it has to do with the rebounds within that decline. And when they finally trigger a signal that, okay, this is the last rebound in a bear market, which is what we saw in July, August, September of last year, and that gold should now have one more decline, spike to new lows, and then it gives you a very clear target for what the first impulse wave of that new bull market should be.
Well, let's talk about that. I mean, you were pretty precise on your targets for how low gold should go. What is your cycle analysis saying for the next few years out?
Well, as far as cycles for gold, I thought we would see an initial advance from actually mid-December of last year is when we got buy signals triggered, 3 to 6 month buy signals. And the initial rally was projected to go into mid-February, and this foreshadowed target that I was talking about told me that if gold was really going to validate my outlook for 2016 and all the way out to 2018, the first thing it needed to do was to exceed the magnitude of its largest rally of the last 3 years. And that was a rally in, or last 2 years, I should say, in late 2013 to early 2014. And if gold was going to match the magnitude of that rally, it had to get up to 1257.5 during this initial surge. And if it was going to exceed it, obviously all it needed to do was go one tick farther than that, and it would give me my confirmation signal. And just on February 11th, it made it up to 1263, and I'm using the April futures as my guideline. But that helped reinforce what I'm looking for over the next 6 months, which is the initial rally into mid-February, and a pullback into March, and another advance into the late May time frame. And then I think that will all be that 6 months from late December into mid to late May, the initial impulse wave of a developing bull market in gold. From there, I think we'll see a decent correction, and then I'm looking for late 2016 all the way through 2018 to be the second, more dynamic impulse wave or advance in gold's bull market. So that's just kind of an overall outline or roadmap of what I'm looking for in 2016 through 2018.
So, Eric, is it fair to say that you don't expect gold to make new lows going forward in the near future?
I don't expect it, but I need some confirming indicators between now and May to corroborate that and to confirm that. Price, as I repeatedly write to my readers, price action is always the ultimate filter. Mm-hmm. So although from a cyclic perspective and from several downside objectives that were met, I do not expect gold to go to new lows, but I need to see price action confirm that expectation so that then I can start building or reinforcing the expectations from that point forward.
Eric, what are your cycles telling us about silver? Or, and my question is too, like, do you follow gold and then just expect silver to be the little brother that kind of follows gold? Is that kind of how you see it, or does silver do its own thing?
In many respects, it does its own thing. And this is kind of unique because not only do you have gold and silver having periods where they're very closely converging and then other times where there's some divergence, but then a second level of that same type of relationship is what gold and silver are doing versus what gold and silver stocks are doing. And each level of relationship there has different variables that can often create some deviation between them. And with gold and silver, you've got gold that's benefiting from a lot of your flight to quality type of or safe haven status. But then at the same time, silver will benefit from that. But if there are still deflationary forces, then silver's role as a commodity is kind of in conflict. So it'll curtail the rallies during times like that, and it'll make silver more vulnerable to retesting its lows or setting new lows, even if gold pulled back to a higher low. And that's actually the type of divergence that's very indicative of a major turning point anyway. And I've even discussed how some of, like, the XAU gold and silver index could do something like that because of its relationship as far as being not just gold and silver, but equities.
Wait, can you... Sorry about this. Sorry to interrupt you.
No, go ahead.
Can you explain that again? What would be a major turning point for the metals? I thought that was a good point, and I wanted to just clear that up. So if you could just explain that one more time.
Sure. It's when it's kind of this way in any market arena, and when you get different components within that arena. So right now we're talking about gold and silver, and even I watch platinum, palladium, copper. Now they don't, move as closely in tandem, but they also give some of these same type of indicators or warning signs, and that is if you have the markets all bottom at the same time, or in this case gold and silver, then they enter their initial advance, and both of them see a decent rally, and then they start to pull back. Well, if you get one of those markets, in this case silver, going back down all the way to its lows, maybe even spiking to a new low, but then quickly turning back up, and at the same time, gold declines, but it bottoms out significantly above its previous low, you have this type of intermarket divergence. One of them setting new lows, the other setting higher lows. Mm-hmm. And I've often seen that, in fact, in overall equity markets and stock indices. That was a classic signal in late 2014 through April of 2015, where you saw certain indices peak all the way back in November and December of 2014 and never set new highs. The Dow Jones Transports is a perfect example. They set their peak in November of 2014. And then as you went through the first quarter, the first 4 months of 2015, there was this kind of residual pattern where you'd have subsequent rallies, and each time it was less of the different indices that would set new highs, even while other ones were setting lower highs. So on an inverse scale, it's that same type of divergence where you're not getting them all making new highs or making new lows during each subsequent move. Mm. And now once that happens, you also need certain things to confirm that they've both turned back up. I'm back to talking about gold and silver now. I'd need to see a couple of key indicators say, okay, they both have put in a low, they both have turned back up, but it was a divergent low. And that's reinforcing to me that on a bigger scale, we're seeing a more important turning point unfold. Mm-hmm.
Eric, so what is your cycle analysis telling us about the indices out there? And I'm glad you already talked about that, and you were able to use that divergence regarding the stock markets and how we've seen that so far. But what are we seeing now in 2016 regarding your cycle analysis?
Well, 2016, what I've been describing is when I thought the second shoe would really drop. And to understand my outlook in the overall indices and equities, I have to go way back for a moment, and that's discussing a 40-year cycle that I have seen that has governed the dollar and currencies. It's governed gold. It's governed equity markets and panics and crashes, as well as bubbles. It's even governed things like food crises, which I think we're going to see in the next couple years. That's a different topic. And it's just been uncanny to me how precise it has been many times. And so as we were going through 2013, 2014, I was discussing this topic and saying how that I thought late 2014, early 2015 would be the culmination of a generational 40-year cycle of inflationary stock market advances. And dating back to the December 1974 low, which came after a 2-year 50% crash in the markets. And ever since that time, equities have advanced on a lot of factors, but one of the underlying threads, too, has been an inflationary move based on a declining dollar throughout that time. And I'm not implying that that's the only factor or even that that's the majority one, but it has been an inflationary advance in equities.
Well, at the 40-year cycle, I mean, it's making me think of the new currency that we've seen every 40 years. And I've heard it put this way, that there's a wealth transfer that happens and it kind of inflates, and then there needs to be some sort of new money system, and then there's a wealth transfer, and that's reflected in the stock markets. Do you see any validity in that, or is there any correlation to in the cycle analysis that you're doing regarding this?
Absolutely, and that's where, when back at the beginning of our conversation, and I talked about certain cycles, natural cycles, time-proven cycles, and to me, the 40-year cycle is probably the flagship of all those cycles, and dating back to even biblical times, and if you view the Bible as a historical account, forget whether you want to apply the religious and spiritual aspects to it. If you look at its historical account, and much of that has been authenticated by other records, the 40-year cycle was just so recurrent and ubiquitous throughout a few thousand years of history, a couple thousand years that are recorded there, and right up to the present. And so that 40-year cycle is one. In fact, one of my websites is 40yearcycle.com, and I try to really delve into a lot of aspects of that, all the way down to things like geophysical, earthquakes and volcanoes, and where you tend to see swarms or clusters of them on that same 40-year cycle. It's also been proven to be a very natural cycle, that there is what's called the Great Conveyor Belt in the sun, which governs solar storms, sunspot polarity, and it's an approximate 40-year cycle that they have identified within the sun's mechanism. So even when you think about climate and you think about the many things that govern Earth's natural cycles, there's a proven 40-year cycle. And many years ago, I started documenting just how it's applied to America. And when you're talking about things even like currency and inflation, and you go all the way back to the founding of our country, and 1775 to 1781 was really the first big experiment with fiat, or paper currency, called the Continentals. And they were issued in 75 and 76, and started to turn down almost immediately, and by 79, 80, they were virtually worthless, and then by 1781, they were taken out of circulation altogether. And 40 years later, you saw the biggest battle over currency control, and Thomas Jefferson was on one side, and all the advocates for rechartering the Second Bank of the United States were on the other side. And Jefferson lost the battle, and in 1816, 40 years from that experiment with the Continental in 1776, 1816, the Second Bank of the United States was rechartered. 40 years later, you saw a period in the mid-1850s where the government started reducing the amount of silver in coins, and by 1856-57, you saw the suspension of silver as payment, and then shortly after, in 1861, suspension of gold. So it was very similar things involving currency, inflation, gold and silver, backing, either solid backing or paper, fiat currency. 40 years later, 1896, you have one of the biggest battles over the gold standard and the election of 1896. And with, there's even speculation that the book The Wizard of Oz was an allegory on the battle between the gold and silver standard. That Dorothy's shoes initially were silver. It was only because of Hollywood and Technicolor that they made them red in the movie. But she had silver slippers walking on the golden path, and the lion, who was really the nickname of Brian, the candidate that was opposed to a gold standard and had the famous "You shall not crucify us on a cross of gold" speech. Anyway, the whole battle over gold standard in the 1890s. Move forward 40 years later, the 1930s, you had the suspension and confiscation and outlawing of gold and silver. 40 years later, the 1970s, you have the Nixon gold shock, which occurred exactly 40 years before the peak we just saw in gold in August, September of 2011. The Nixon gold shock, when he slammed shut the gold window, was in August of 1971. And you had this 4 or 5 year period of the collapse of Bretton Woods and oil becoming really the de facto backing of our currency. And then 1976 is what I pinpoint as the real, the most, the greatest example or affirmation of what was going on, and that's when the Jamaica Accord was signed, not just by the U.S., but most of the Western world. And in effect, it was what I call the divorce decree between our currency or any currencies and gold. And that kind of codified into writing that, okay, gold was no longer had any relationship to our currency. So to me, that triggered a 40-year period of testing, which is really what, when you look at the biblical examples of the 40-year cycle and all through this, it's a period of testing or preparation, kind of like you were just explaining, where certain things occur, and after 40 years, they've reached their maturity, they've come to fruition. And so 2016 to me is when a whole new cycle of that battle between gold, fiat currency, inflation, that's one of the big reasons I kept pinpointing 2016. There was a lot of other intermediate cycles and indicators, but this 40-year cycle is the one that really governed all this. And as I paused, I just realized that I kind of went on a segue there away from your discussion on the indices.
No,
but
that's fine.
It's all tied together.
Sure. No. That's fine, actually. And I have a tangent question, kind of in conclusion here. We're getting to that 30-minute mark here, but in what is your thought? And I ask this because I feel like a lot of us, we wish there was a gold standard. We wish that the money that we had retained its value. And I wanted to get your thoughts on this because I know you've done a lot of research on it. What does a thriving economy look like under the gold standard, considering a lot of us haven't really experienced a thriving economy under a gold standard?
Well, I can give you a quick answer to that. I don't know. And that's the thing that I have said. I don't claim to be an economist, and I don't think anyone could really pinpoint what that would look like, because there would be such a seismic shift that would have to go on to get back to that. You know, there have been a lot of benefits and a lot of the innovation and ingenuity and prosperity of the last 100 years has been a result of being able to influence the money supply a little bit more readily, and so I think that even all those that, you know, yell and scream they want the gold standard back, I don't know if they'd really want what they wish for. You know, be careful what you wish for; you might just get it, because you know, it is a very constrained and very restricted type of approach to currency, to banking. Now, I also think that the tangent we've gone on is ultimately going to be devastating. So it's, you know, which is the lesser of two evils type of thing. But I don't know exactly what it would look like under a gold standard.
Okay, well, and that's totally fine, and I think that's the most honest answer most people won't give, because everyone will say, hey, you know, this is what we need, this is ideal, and you know, even though I do believe in the gold standard, I do admit that I don't fully understand all the intricacies of what a gold standard would actually entail. And I guess one of the things that I would appreciate about a gold standard is that as the economy grew, there is a limited supply of gold, and my money would actually be worth more and more over time, rather than this constant eating away at my purchasing power, which I know Keynesians want us to be fearful about the money losing its purchasing power. So they have this artificial economic stimulus to go out there and continue to buy stuff, because we know that our money's going to deteriorate. And again, that's like artificially lowering interest rates. That's like QE. It's another aspect of artificial stimulus to the economy. And I do believe that under a gold standard, we actually would have money that would retain its purchasing power over time. But Eric, I want to say thank you for coming on the show with me today and just sharing a ton of excellent information with us and giving us your insights. So in conclusion, do you have any last thoughts? And with that, also let people know where they can find you and learn more about what you do.
Yeah, as far as last thoughts, try to go real quickly. One was a more comprehensive answer to your question about the indices, and like I said, I thought that 2016 is going to be a year where we do see several waves down in indices, and that's the kind of correcting this 40-year of inflationary advances. Number two is with respect to gold and gold standard. The other thing that's intriguing and could be scary too is what other nations are doing to try and get gold backing, or at least some gold credibility to their currencies. And it's very intriguing to read about the number of nations that have been repatriating or attempting to repatriate their gold since 2011. And that's an interesting omen for the coming years. And with respect to finding out any other information, the one website that I would direct your listeners to is 40yearcycle.com, and that's the number 40yearcycle.com. And in addition, as far as more specifics on the publications we offer, that type of information can be found at our flagship website, insidetrack.com, and that's with an extra I in the middle, so it's INSIIDETRACK.com. Although I would say we're in the midst of a major overhaul there, so some of the stuff isn't as timely as I'd like it to be right now, so that's why 40-year cycle is probably the best one to go to get a lot of the timely analysis. And they're the two places that your listeners can go to find out more information.
Eric Hadik, everyone. Eric, thanks so much for taking the time to come on the show with me today and for sharing amazing content with our audience and just encouraging us to be in the know. So, Eric, thank you very much for being here.
Thank you very much for having me, Kenneth.